John, some of the expressions, terminology used in fixed interest can be quite complicated for our type of investor. Do you think you'd mind just explaining a little bit about, in a basic language as you can, what some of them actually mean? And maybe if we start with inflation risk and credit risk, which, as you said earlier, are two of the main points in the Strategic Bond Fund.
Yes, of course. I mean, inflation risk is the risk that inflation, so a general rise in price levels, increases beyond what's just baked into current market expectations. So essentially, if you're receiving a fixed income, as clients would of these funds, you don't want that spending power to decrease because of the general rise in prices of goods and services. And central bankers try and control inflation by rising interest rates appropriately at the right time. What we were referring to there was the central banks are so keen to get the economies growing again, they may tolerate a bit more inflation to get unemployment down.
Yeah.
Now, and credit risk, credit risk is the risk that I lend money to somebody and it defaults, it goes bust.
Yeah.
So again, we'd run a portfolio of over 100 different positions in the fund. My credit analyst will ensure that we're doing the work, kicking the tires on those individual companies. You run a portfolio approach because invariably some businesses will go bust or have to restructure their debt, like Yale have recently had to restructure their balance sheet. But it's the core part of the job, looking at lending money to good companies and avoiding bad ones. Bad companies go bust. Parts often due to structural decline, like directories, and some go bust because of the cycle, because they're too cyclical. They might have too much debt, gearing, too much gearing. What's gearing? Gearing, too much borrowing against their assets, and in an economy which is tough or shrinking, like yourself, you wouldn't want to hold too big a mortgage against your own house, would you? So those sort of things is what we look at. And
derivatives was another word which we've mentioned a few times, and also hedging out, because you did mention you can use derivatives to hedge out. So if you could just a brief example of what a derivative is and then what the hedging is.
Yeah, I mean, a derivative is not a physical position. So when you buy a bond in, I don't know, Tesco's, you actually put cash down. When you buy a derivative in Tesco's, you only put a tiny bit of cash down, and the profit or loss on that derivative contract is marked every day. So if you make money, the counterparty to whom is the other side of the contract will post money to you in profit. Alternatively, if I'm losing money on the contract, I would post money to the person on the other side. That's done every day beyond a certain threshold. Now,
and we said in the main commentary, it is efficient and much more cost-effective for making short-term swings in the portfolio.
Yeah, that's exactly right. So derivatives can get baked down into a number of different sub-asset classes, and typically one of them is credit derivatives or CDS. They tend to be single name, as in Tesco's or Nationwide or whoever. Or you can buy an actual index of credit derivatives, and you can trade the index or 50 underlying credit derivatives. That index itself is more liquid than the 50 underlying, and hence that index trades a lot with everyone in London and beyond. Now, you also have derivatives in interest rate futures. So again, there is the LIFE, London International Financial Futures Exchange in London. So again, instead of physically buying a gilt, I can buy a synthetic position equivalent to buying a gilt. And again, I would post margin or cash on the profit or loss on that position every day. The gilt future trades in hundreds of thousands of pounds every day. It's a sort of generic, stylized one gilt, if you like, which has infinite, you can buy or sell it in an infinite amount. And again, that adds to the liquidity. But ultimately, all it's doing is mimicking the gilt market.
And then to liquidity, a hugely pertinent subject at the moment. What, in as basic language as we can, does liquidity mean generally?
Yes, well, in a corporate bond context, typically it means can I turn my portfolio into cash, how quickly and at what cost? So there are people who are obliged to make markets in corporate bonds, and they buy and sell corporate bonds all day long, but there's a cost to doing that. And in bad times, liquidity worsens, because if I'm going to sell my bonds to someone, the price falls. And liquidity really is a measure of how quickly I can turn my bonds into cash and at what cost. This should not get confused with central bank liquidity, which is essentially the Bank of England and the Federal Reserve in America putting money into the banking system to try and make it easier for people to borrow money via the banking system, and that's typically what central banks do in financial crises.
And another term used, and again we mentioned it in our commentary, is risk on and risk off. Just a little bit about sort of what they are.
Yes, it's quite a common phrase now, but something which we didn't used to have. Basically, because of those liquidity injections we were speaking about, so the central banks pumping money into the banking system, that means asset prices, so equities and bond prices, tend to rise when the central banks do this, and that would be a risk-on environment. We've added risk ourselves on the back of Bernanke last Friday, so that would be a risk-on environment. Now, against that, there's still a lot of problems in the world regarding the solvency of a lot of countries, and to a lesser extent, countries. So when there's not bouts of liquidity, market participants, as in you and I and our investors, start worrying about how solvent or whether these businesses have enough cash flow to service their debt. All countries have enough cash flow to service their debt. And people worry more about, Spain and Italy and Greece and so on a more fundamental basis. And in that environment, there'll be risk off. So they'd sell away risk, they'd sell away equities, they'd sell away higher bonds, and the market would fall.
And in that sort of climate, people tend to go for AAA nations like Germany, like UK,
yes, exactly.
And that further pushes the gilt price up and the yield on them down.
Exactly. So what you do, you sell your equities, you sell your higher bonds, and you run and put your money in Germany and America and our own UK gilt market. And as you say, that would push the price of gilts up and the yields down. And a recent phenomenon is this sort of short business cycle where essentially you have the liquidity injection, everything runs up. Then fundamentals reassert themselves, people get a bit worried again, and they run back to the gilt market. And
that's the risk on, risk off.
Yeah, exactly. And the cycle used to be quite long and pronounced. The economic cycle now is quite short and quite sort of punchy and a bit jagged. And it kind of lurch, you can lurch on, it can lurch off, and that is what risk on, risk off is.
John, thank you very much.
Thank you.